Look, cash flow is great. Cash flow is a risk reduction. So when you're buying cash flow, you're naturally going to reduce the risk of your investment to some extent. That being said, you're probably giving up something in the long run. And so, when you're buying a piece of property right now, let's say you're spending $10 million on a piece of property and you're going to generate $700,000 in net positive cash flow, or you're buying that on a seven cap. Well, there's likely something that you're giving up for that. The likelihood of growth may be smaller. You're giving up something for that amount of cash flow, or it's going to be an extremely hard property or hard asset to manage. And on the flip side, a property that may not have significant cash flow early on, but it needs a little bit of turnover and a little bit of work in order to build up to that cash flow, may have higher overall upside value on the back end. And so, I think just chasing cash flow, yeah, we could go out and buy properties today that have a little bit of cash flow with them, and investors are looking at 3-4% cash flow right now. And if they get 3 or 4% cash flow, they have a good that's a good investment. And then you add the growth on top of that, where you're hitting an 18-20% annualized rate of return. Then you've got a really good investment. Well, we could go out and buy cash flow all day every day, but you're going to give up some of those bigger upside opportunities. Whereas on the flip side, we're looking at a couple of deals right now, as you know, that we've got contracted that are not going to cash flow for 3 to 6 months as we step in and do unit turns. But their overall upside potential is 26, 28, 30% annualized rates of returns. Because we're moving, one of them specifically is a conversion from workforce housing to student housing in a market where there's nearly 1,000 kids living in short-term hotel type accommodations. And so there's a huge opportunity there, and the value add, we're going to go in and spend about $8,500 a unit, and that's going to add about $300 a month in income, or $3,600 a year. So that's a north of 30% ROI on that unit turn spend alone. And it's going to create huge upside opportunity on the back end, and we're going to give up a little bit of cash flow early on the front side. So I think having short-term views at, well, I want cash flow from day one, you're not looking at the overall picture as a wealth building mechanism. And the thing with real estate is it's not a get rich quick scenario. You're not going to it's not going to have the Nvidia effect that we saw, what was that, maybe 5 years ago or so, when somebody that got in, and Boone, I think you were a part of that opportunity when there was massive growth there, and overnight your stock portfolio jumped up by 20, 25, 30%. You're not going to see that in real estate. The thing with real estate is it's not get rich quick, but it is get rich for sure. When you put money into it, you play the patient long game, it is going to build wealth. There's a reason there's 2,000 new millionaires every year, and the majority of those are built through real estate. There's a reason that a majority of the high net worth, the wealthy individuals in America have their money in real estate. It's get wealthy for sure, but it's a long, patient game.
So you mentioned several acronyms there, and obviously, one of the best investors of all time, Warren Buffett. He does not play the get rich quick scheme. Now, obviously, he's in businesses mostly. He does do manufactured homes. He does do some real estate, but he plays pay a fair price for a fair asset, get a fair return, and be able to predict growth. You talked about internal rate of return, average annual return, annualized rate of return, return on investment, ROI, IRR, AAR, ARR, all those different things. Brian, I want to come to you. How does a sophisticated investor look at a investment and measure success on it? beyond just looking at cash on cash?
Yeah, I'd say there's a couple of metrics that you have to look at. I mean, your basic return on investment, if you kind of just really want to dumb it down and simplify it, is your net operating income over your total investment. And so you can look at it from that standpoint, which is probably an accurate way to look at it. You can also look at it on cash on cash. I mean, that's kind of a return on your out-of-pocket cash in a specific investment versus looking at the total property price. And if you think about it, it's really just your annual cash flow over the total amount invested. So I would say you want to look at two things. I wouldn't exclusively look at cash on cash. It's really beyond that and looking at overall return on investment, which you have to look at kind of holistically as far as your overall net operating income based on your overall investment.
Yeah, there's there's a number of, I think, levels that you can go into. Brian made a good point that you don't want to just look at one. I look at a number of them, and one thing that I learned when I was working at KPMG, and I focused on private equity. One thing that I learned from the Bass family, and that I learned from the executives at TPG, at a number of the big private equity firms, was equity multiple. How quickly can I turn my money, and how much can I turn it by? And it was always kind of, the going factor is 2 times in 5 years. So I invest $500,000 in 5 years. I want that to be worth $1 million. Now, some of that comes in the form of cash flow. Some of that comes in the form of growth. Some of that comes in the form of, you know, making money in the buy, so buying at a discount. And then you've got the tax equation that's built into that. How much of your overall earnings, when you're taking a comparison between a private equity deal that operates with net operating losses for the 4 or 5 years that you hold the deal, and then you have a huge upside exit, or you've got a real estate deal that maybe has a little bit of cash flow along the way and then a big upside exit, but you're going to get a tax advantage on both of those deals versus the equities market. And maybe you double your money on paper in 5 years with all three scenarios, but tax affected, the equities market dips down and it's a 1.8x multiple, whereas the real estate hits at a 2.2 or a 2.3 because you can take those tax losses and utilize them towards another piece of real estate or something like that. And so you've got to look at all of that. And then, as I mentioned, IRR, or internal rate of return, really what that is your average annual return with a time value of money component tied to it. So I invest $100,000 today. So that's a negative outbound. It's going 100,000 out. And I get zero cash flow in year one. I get a little bit of cash flow in year two and a little bit more in year three. And I sell in year four and I get all of it. Okay. And let's say your average annual return came out to be 12%. Well, the IRR is probably going to be about 11% because you got a majority of that at the end. And so you're not taking your total income or your total growth and dividing it by 4 years. You're doing that, but then you're allocating the majority of that growth came in the fourth year. Whereas on a flip scenario, let's say you acquired it, 100,000 went out the door, nothing in year one, a little bit in year two, and you refinanced in year three, then a little bit, and so you got a big equity check out, and then a little bit in year four, and then you sold in year five and got another big check. That scenario, your IRR is probably going to outpace your average annual return because you got two big checks back to you, and so the time value of money gives you a booster there. And so it's good to understand your average annual return. What's your ROI? What did your money do on a yearly basis, looking at the grand scheme of the investment? But then also understanding that if you had to give up some in the front end to get that on the back end, you're then able to look at the risk for that investment. How much am I giving up in cash flow to get a bigger upside on the back end, or how much am I getting in cash flow to give up a smaller on the back end and my IRR is lower?